afternoon. Thanks everyone for being here. It's a great pleasure to have you here, and thanks especially to the Foster School of Business for having us here for the NIRI Seattle March event. Jim, really appreciate your hospitality this afternoon. It's great to see so many familiar faces and some that are new. For those of you who I haven't met, my name is Randall Hopkins. I'm the president of NIRI Seattle and also head up NASDAQ's capital markets activity here in the Pacific Northwest, as well as the Intermountain West. For those of you who are not familiar with NIRI, that's the National Investor Relations Institute, and the focus there is really the sort of perfecting the art and the science of sort of connecting the public company message with investors. And I think all of us here in the room has a lot of interest in that one way or another, either because we're members of publicly traded companies or we invest in them as individuals, or our institutions have foundations that have positions that benefit from that. Certainly, I think it's also fair to say that all of us have a very large stake in the economy, and that's why it's my great pleasure today to have NASDAQ OMX Chief Economist Frank Hatheway with us here today to give us a little bit of a sense of kind of what we're seeing in the markets. As you probably read from Frank's bio, certainly a lot of experience in working with the SEC around market structure, around capital formation, and really perfecting that part of our economy. But I know that a lot of us have interests that go well beyond some of the minutiae of market structure, and really pleased to be able to have Frank here with us today. One other thing I'd just be remiss if I didn't mention that Frank and I have been with NASDAQ together for many years now, and I've had the great pleasure of knowing sort of what a smart man he is and what a brilliant mind he is in terms of helping guide our business, but also he and I often are crossing in the hallways on Saturday and Sunday, doing God's work for NASDAQ, and I can tell you that he's also a great man. So it's certainly my great pleasure to have him here with us today, and please join me in welcoming Frank.
Oh, thank you. Very kind. Appreciate that. Thank you, Randall. Mic's working, Mr. AV Tech? Good, perfect. So I want to join Randall in thanking Jim and the Foster School for letting us have use of this beautiful facility today. It's I taught at a state university for about 8 years in the 90s. We didn't have any auditoriums that looked like this one. I bring that up a couple reasons. One, of course, to compliment this building, but the other is to point out that if need be, I could talk nonstop for 4.5 hours. And
there are no beds.
You just ask any of my students. And I don't particularly want to do that. This is set up as a fairly formal environment with you all sitting there in your nice straight rows and me standing up here. But we really don't have to operate that way. This is a relatively short deck. I'm not going to be going through 400 graphs in an hour. It's going to be about a dozen. And it's designed as much as anything else is to get a conversation going about things that you see either in the local economy, your businesses. It's a mix of a little bit of macroeconomics and a little bit of what we see going on in the stock market. So there should be different things for different perspectives to talk to or be interested in. Background on me, my group, and what we do, so you have an idea of sort of what's fair game. I run the research group for NASDAQ. We are based in Washington because our main responsibility historically and at present is working with the SEC and the other regulatory bodies that exist there. So there's a lot of things we do on the regulatory side. On the operational side of NASDAQ, we actually sit within the Office of General Counsel. So I'm an economist that works for a lawyer, which I think is a bit of payback on my boss's part, because he was the general counsel to both Richard Rubin and Larry Summers in the Treasury Department during the Clinton administration. So he had to work for an economist. Now he has an economist working for him. Half my team's DC, the other half is in Stockholm. That's the OMX part of NASDAQ OMX, and I will be in Stockholm and Europe generally next week. So there's also, and we have a very similar remit there, and obviously have some experience with the European equity markets and the state of the European economy, although this talk is exclusively US focused. That doesn't mean the conversation that grows out of it has to be exclusively US if your interests run at least toward Europe. If you want to ask me questions about Argentina, and I've had audience members do that, I will tell you right now we have really no business relationship in Argentina, and anything I say about Argentina is going to be a wild guess. But like anyone who is a professor, and no offense, Jim, to you and your colleagues, there's nothing I won't offer an opinion on. All right, so let's just sort of start off with where we've been and where we're likely to go, and set a little background on the way I look at the economy and the way I look at the economy as it exists here in 2014 and going forward. It's been, all in all, since the end of the financial crisis, not really a horrible state of the economy, not a particularly good one either, but it's been choppy but moderate. And we have simply here GDP growth quarter by quarter, not annualized. So if you have your own favorite number for looking at GDP, these are the quarterly growth rates. And you had a lot of chop. And I think that's really been the story since the financial crisis. So you have European sovereign debt crisis phase 1, knocking the stuffing out of the US economy in 2011. You have the European sovereign debt and US downgrade sovereign debt budget crisis in the summer of 2012. Again, knocking the stuffing out of the economy. And we'll see both these things popping up in some of the other statistics we look at. But one of the things you want to call your attention to is 2013 was actually pretty good. 2.5%, somewhere in that range. The fourth quarter just got revised down, actually a fair amount. So we'll see where the year winds up when the final revisions are done. But it was a halfway decent year. I didn't come here at the end of 2012 to talk to this group, probably because Randall didn't invite me. I'll get you for that. But I certainly did talk to a number of NIRI chapters at the end of 2012. And at that time, if you remember, we were looking at going off the fiscal cliff. We were looking at sequester. Economic forecasts ran from everything not that different from what we actually saw to zero economic growth for 2013. The government budget office Congressional Budget Office had a very low forecast because they have to assume that the laws in place will be what happens, and that was the fiscal cliff. And I think at least one of the big investment banks had a very low forecast because they figured we were going to go off the fiscal cliff and go through sequester, and we did. We went off the fiscal cliff, we went through sequester, and the economy kind of had a slow bit right at the end of 12, and it did some weird things that we'll talk about in a few minutes. And the beginning of 13 wasn't gangbusters, and then it kind of sorted itself out, and off we went. And in many respects, I didn't find that as a surprise, and that kind of sets my theme for a lot of the remarks this evening. One of the things that going off the fiscal cliff and the sequester did is it took part of this question about what we're going to do with the structural deficit in the US off the table. It was a $300 billion reduction in the deficit. It might have been a awful ugly way to do it, but it's the way it was done. We had a tax increase, a pretty big one. We had some spending cuts, pretty big ones. They weren't necessarily targeted per se, but they did what they did. And so you get into 2013, and the private sector says, okay, we kind of know what the rules of the game are, what taxes are going to look like, what Social Security taxes are going to look like, what spending patterns are going to look like. Fine, we'll get on with what we're doing. And I think that's a lot of what we saw last year. We also saw probably a little bit of a kick from accelerated income. And it'll show up in some of the investing trend charts I have later on. But at the end of 12, for people, particularly people in income brackets that were going to see a pretty big tax increase, there were things done to accelerate income. That creates a liquidity shock to the economy. People spend it. You can see it show up, as I said, in investment trends. And that's probably part of what made the first part of 2013 a lot better than anybody thought it would be. and it's had a residual effect dragging on to, or carrying on to the rest of the year. Now that's behind us. And as I said at the beginning, I'm based in DC. I am not really part of the DC establishment, though I do work on Capitol Hill, euphemism. But they've passed a budget act that gets them through the election without having to think about anything too hard to 2015. And so we're not going to have any huge shocks in the government, and we're not necessarily going to fix any of the remaining structural issues, either with the US fiscal situation or, more importantly, with our European trading partners. They still have some significant structural issues between the competitiveness of Northern Europe and Southern Europe. And although Dr. Draghi is going to keep the economy, or do whatever it takes to keep the euro going, keep the European economy going, that's not really addressing the structural problems. And those are still out there, and there's still threats to economic growth in the sense of there's a drag. They're both a drag on economic growth, and if the situation gets sufficiently unstable, they really could be a threat. Maybe not as dramatic as what we saw in 2008, but still having effects like we see in 11 and 12. One of the other things I want to point out about 13 before I leave this graph, we had some things happen in 2013 that, had they happened a couple of years earlier, may well have caused spikes like this. We had a Greek election, Greek government fell, we had the Italian government fall. We had scandals and political scandals of various types involving Spain. We had a situation with Irish banks essentially laughing at their bailout. All these things in an earlier environment might have created a much bigger hiccup in the financial markets and the debt markets and the economy and the markets that sort of said, yeah, okay, fine. We're not going to react the way they act in the past. This is not that big a deal anymore. So I think we're moving into a very different phase now of the cycle. I'm going to spend a minute. Anybody want to argue with me at this point? I'm happy to. That's what makes these things fun from my perspective. What really makes it fun is when I get the audience arguing with itself, and that does happen every now and then. So if you want to make a statement or ask a question and see if anyone up on the other side of the audience jumps up and starts disputing what you have to say, well, I'm more than willing to see if that happens. But if not, we'll start with a couple of things. Well, one thing that I think we're all pretty aware of, and another maybe less so. But let's just begin on the top right. So this is essentially a graph of the change in employment relative to the pre-recessionary peak for the current recession. And that peaked out in late 2007, which is why it's labeled 07, and for prior. And I may have left off your favorite recession if you have one that I did include, but essentially that's enough to make this point. The job market hasn't gotten back to where it was prior to 07, and in all these previous recessions, the job market had recovered its losses essentially within 4 years, and we're now pushing 6 years out and still not quite back to neutral. You hear about this showing up lots of different ways. The point gets made in different statistics. One of the more widely used ones out there is the labor force participation rate and this notion of discouraged workers. However you want to look at it, this way or one of the other ways, we do have this notion that of working age adults, and by that I don't mean sort of everybody who's an adult, I mean adults between 25 and 54. Those are people who, in my view, have to work. They're sort of too old to be sort of home students, so obviously we all know students who are past 25, but the majority of them too old to be home or being supported by their parents one way or another, and too young to be retired. Though again, we all know people who retired at 40, but demographically, you're not retiring at 54. You're an adult who needs to support themselves. And essentially 5% of that group, 6-7 million people, aren't working now relative to 6-7 years ago. And you have a little bit of trouble explaining that with early retirement because it's a constant age group. The folks who are retiring are moving off that, past that 54 slot cutoff. You can do a little bit with increases in disability rates, but essentially you have a fairly significant change in labor force participation. And it reflects a downtrend that's been going on since probably the late 90s. We peaked out at maybe 80-some% of this working age cadre being in the labor force. I think there's a lot of implications for that. For those of you in the consumer business, I think there are implications for that is, essentially, as we'll see in a few minutes, less consumer disposable income. These adults are being supported by someone, whether it's a government program or another adult. And it may well affect what consumers decide to spend money on, where consumers find value. It may also have an effect on us. We run a securities market, capital market. People need surpluses over consumption to save and invest, and lower the income is, the lower surpluses are going to be. These are longer-term trends that we don't really know how it's going to play out. Much as if we were sitting here in 1960s, where the labor force participation rate really begins to increase as women enter the organized labor force. It would have been hard to foresee exactly back then what the changes would be on the economy and on consumer goods markets in the economy. Companies or individuals who got that right did very, very well over the following 30 years, whether they were lucky or smart. It's anyone else's guess. But if we are seeing some kind of secular change here, I think the implications can be pretty strong as we work through what this means. One of the things that it doesn't mean, and this is now where we get to the bottom chart. So we haven't had employment get back to where it was 2007. But one of the things that has happened, and it's been true really for about 4 years now, is the level of job losses in the economy has been lower than it was in the boom years of 2005, 6, 7. And that's a little weird. You get job losses kind of two ways. One is sort of the obvious, I'm shutting down my plant and I need fewer people. I've lost my markets, or I'm moving production overseas for lower costs, or whatever it may be. The other way you get job losses is what I'm going to call frictional job losses. So I have 20 people who work for me. And if I think I can do better for some of those folks by going to the labor pool and replacing them, I will let somebody go, and I will hire a replacement. That's the other way you get job losses. If the job market's tight for the skills that are in demand, I am less inclined to let somebody go because the chance I can go into the job market and find someone better is relatively low. I keep what I have. And I think that's the other thing that you get out of this job loss chart is for the skills that are in demand, it's not particularly a bad economy. For the skills that are not in demand, it's not very good. And that's how these two things, in my mind, link back together. If you have skills people want, you can find a job. And if you're an employer looking for people with those skills, it can be difficult to find them. However, if you've got a skill that was in demand in 2007 and it's not in demand now, they're not coming back, or at least they haven't come back yet. You take these two things together, and there's really two dimensions to this story. One's a personal dimension, and I'm an economist. I'm going to prove that I have no soul by not even acknowledging the personal dimension after this. And then there's sort of the macroeconomic implications of this, and that's what I'm going to talk about next. So we have the job loss piece, and then we get into sort of a big so what, and maybe, just maybe, I can go through these two slides, and given some of the issues here in Seattle, I can provoke you guys to say something, but we'll see. All right, people don't have jobs, and we had a recession. So a recession this is consumer income, and just to show you how to read it, we have consumer income in $1 trillion running up the left-hand side. And obviously this is just by year. And yeah, the economy's growing pretty well. I mean, you think about what inflation was doing between 2000 and 2008, and okay, 2000 was, again, kind of the end of a boom there. And the tech bubble bursts and other things happen. But pretty steady growth in real post-inflation disposable personal income. This is the money you have left over after sort of your non-discretionary costs, taxes, and what have you. Perking along at around 3% for around 7 years pretty steadily. Then we have the global financial crisis, and it flatlines. Not particularly unusual that it would do that. The financial crisis and the recession is worse than normal, so a flat line is worse than normal for a recession, but at least the growth rate going off at a much lower pace for a while is what recessions are all about. It's one of the reasons we don't like them. And then growth resumes, and it resumes with at a much lower pace, and essentially it's a little over 1%. So you wind up with this gap. And it's a gap of about 8%, or if you like dollars more, about $1 trillion relative to where we'd be. Normally what you see after a recession when you get the kinds of upticks in employment that that top graph shows is the growth rate immediately after the recession is actually greater than it was prior to the recession. That did not happen this time. And we're now 4 or 5 years after the peak, and it's not happening, and it doesn't seem, there's no real indications on the horizon this is going to pick up. Yeah, there's spikes. The spikes are as much statistical anomalies as anything else, but for the most part, it's remarkable how much these things stay on trend. If any of the macroeconomists from the econ department had joined, we would now get into an argument about whether there's a unit root in GDP growth. And that would take me back to my old life, and I'm perfectly happy not to get in an argument about whether there's a unit root in GDP growth. And for those of you who have no idea what I'm babbling about, be thankful. So that's the income side of the equation. And the income side matters a couple reasons. One, it helps our sense of psychological well-being if our incomes are growing. But really more importantly and fundamentally for someone like me, it's what provides the basis for consumption, and consumption really what goes into GDP, though obviously you can measure GDP from looking at income or looking at consumption, but again, that gets into more macroeconomics and probably most of you have an appetite for. So here's consumption. And it looks pretty much the same, perking along just about 3%, which kind of makes sense. So your income grows, most of us are going to spend it. And if one grows faster than the other for a sustained period of time, that's unstable. So it's kind of good that they were growing more or less the same rate from 2000 through 2007. Again, a dip, and now sort of not a flat line, but a real dip in the recession, in the financial crisis. And when I was talking to groups like this, in the winter of 08 or early 09, I think the main question, either explicitly or implicitly from the audience, was always, are we going to get through this, or is this sort of the end of the world as we know it? And so you got real declines in how much money people spent as they were sort of saving for Armageddon. And then the growth rate picks up, and again, it picks up at a rate now about a percentage point below where it had been before, and now we're looking at a gap of about the same magnitude and about the same percentages, roughly $1 trillion, give or take. And about 9%. And it doesn't seem that that's closing. And I think, again, in and of itself, you can conclude off this, well, maybe the economy getting less of a kick from the consumer, other parts of the economy, government spending, investment, the other things that make up economic activity are going to pick up the slack. And since I'm an economist and naturally gloomy, I throw cold water on that by pointing out that the consumer as a percent of the economy is actually bigger now than it was back in 2000. So even though the consumer is in much worse shape relative to the 2000s and their experience over the last few years, they're more important in overall economic growth. So now I'm going to sort of prove I'm from DC. Say, okay, we have this gap in consumption, and we've got this gap in income, and income is what fuels consumption. So what we have to do is make people's income go up. So how are we going to do that? Well, let's raise the minimum wage. So if you're a politician, and I do spend time hanging around with those folks and their staffs, that's a reasonable solution, thing to do about all this. People are worse off, well, we'll make them get paid more. Now, if you're an economist, you sort of listen to that thinking and go, it doesn't really work that way. If you could legislate prosperity or utopia, people would have probably done it by now. And even if you're sort of not that pessimistic or cynical about power of government, you also point out that increasing minimum wage doesn't sort of increase the value being produced by the economy. It just kind of redivides how the economy is being laid out. Where I live, I won't necessarily pick on the minimum wage debate here in Seattle, because from what I understand, it's pretty heated. So I'll pick on the minimum wage debate where I live in DC. So the district is going to raise its minimum wage to $11 and change over the next 3 years. And the 2 suburban counties on the Maryland side are going to do likewise. The state of Maryland is debating whether it's going to do that. And the state of Virginia, and for those of you who have any knowledge of Greater Washington, you know it sits right between the 2. The state of Virginia is having none of this and is not going to be increasing the minimum wage. And it's going to be interesting to see in local areas how all this plays out, whether we're talking about Washington State, what those of us in the gloomy profession always do. Yeah, you're going to pay some people more, and some people are going to lose their jobs, and net it doesn't make a really huge difference. And that's the economic orthodoxy, and we'll see if it works out that way this time. I have no reason to believe ex ante that it won't. But it is a political response to this issue and this gap. And you think about the levers they have, they're not a lot. They can't get those of us who run businesses to invest more, hire more, without creating some incentives to do so. And even there, the incentives don't really create economic wealth per se. They just reslice or restack the deck. One of the things that struck me about this recession, this goes back a number of years now, is that this is not the first one, the second one, the third one. I don't even want to count how many recessions have actually been through by now. But most of the time you get an argument going on about a job training program. And you can have your opinions of whatever stripe about whether you think those are a good idea. And we have them or we don't have them depending on who controls Congress, who controls the White House. But we usually start talking about them when there's a recession. It's often part and parcel with extending unemployment benefits and things like that. We didn't this time. It was kind of odd. You think about what the stimulus program did. It essentially transferred money to companies to keep them afloat. It transferred money to state and local governments to shovel-ready construction projects or keep public sector employees in their jobs. There wasn't really a retraining program set up on a national level. And again, regardless of whether it works or it doesn't work, I think one of the things that signals when you put one in place is that there are skills, there are jobs that were in the economy before this recession happened that are gone. And you as an individual need to think about what you want to do, whether you go into a formal training program or just retool yourself. And we didn't send that signal this time until State of the Union address earlier this year. And that's, first place, rather late. You think about how recessions work. And secondly, given the environment in DC not going anywhere. But you can see, if I'm a politician and I want to grab a lever and I can begin to understand now, without my economist hat on, the personal pain that gets associated with some of these more dispassionate numbers, well, if people don't have the income, we'll legislate more income. I don't know, or executive order more income, depending on sort of what view you're working from. I don't, as I think clearly indicated, expect that will have much impact. I do think if it happens where I live, or if it happens here where you all live, or if it happens on a national level, it will cause adjustments in the economy. And one of the things that happens when you have adjustments in the economy, and we'll go back to this guy, is economic growth slows down for a while as we work on figuring out what that adjustment means. So it's not necessarily a salutary thing, and I have no idea why I have consensus spelled wrong. I must have used this slide for 4 years, and consensus hasn't been spelled wrong before. A minion will pay for that. But yeah, if it happens in Maryland or happens in the 2 counties around the district or the district itself, I do think it'll slow down growth of the economy. If it happens on a national level, I think it'll do the same thing. And I don't think you'll get a permanent kick with growth rates here in consumption or in expenditure back to levels that we saw prior to the recession. I think that essentially takes an improvement in the capital stock and, if you will, clarity on some of these structural issues that we haven't addressed. All right, so that's it for the macroeconomy. Nobody's disagreed with me yet, so I'm either brilliant and ready for the Nobel Prize, or it's late and you've already had a drink or two and it's sunny and it's a nice day. But we'll move on into sort of the stock market piece of what I want to talk about. And we're going to link these two by starting with the consumer confidence, because investors, it's consumer confidence and investment behavior don't track one for one, but there's a relationship between the two, because they're, again, all about what you think in the future. If the future is going to be lousy, you're not going to be investing in stocks. You're not going to be investing in any kind of long-term investment. If you're not confident as a consumer, you're not buying things. If you're not buying things, my company isn't generating revenue. If my company's not generating revenue, it's not expanding, its earnings aren't growing, you aren't buying shares in it, the stock market's not doing well. So I usually will take a minute and look at consumer confidence. This is a survey. I am not a huge fan of surveys. I prefer what people do to what people say they're going to do, but it's not bad. And again, we can see the financial crisis as a low point for consumer confidence. And I think, interestingly enough, we can see the European sovereign debt crisis 2011 edition as another low point in consumer confidence, indicating at that time how sensitive the U.S. consumer was to anything that smacked of return to the Lehman days. And you go into 13, and what I was saying earlier, how resilient we've come to things that perhaps back in 2011 would have spooked the devil out of us. I think one of the things that helps us feel better in aggregate about the economy is housing prices. Whether it's a bubble or whether it's not a bubble is a separate question. But if we look at a couple things, one, housing prices, and then secondly, proving that financial wizards are as bad as timing as anyone else, the Standard & Poor's Home Builders Exchange Traded Fund, an exchange traded fund that's a portfolio of home builder stocks, which was launched right around the peak in the housing market. Both of them began to turn up a couple of years ago and are frankly been doing pretty well through the end of 2013. The ETF, Exchange Traded Fund for Home Builders, began rolling over. But the stock market is generally speaking, a noisy but forward-looking view for the economy, and the outlook for the home builder stocks, maybe not as exciting as it was back in 2005-06, but still not bad. So for at least a subset of the economy that owns homes, this is something that's a bit of a positive shot in the arm for how people look at things. As is household wealth, measured as net worth. Now, this household wealth is held by a small percentage of households. So this is not the experience of the same set of people I was looking at when we were talking about consumer income and consumer spending. That's pretty much everyone in the economy. When you're talking about home ownership, it's half, roughly, households in the United States, a little over. When you're talking about household net worth, particularly when you get into financial net worth, which really drives the big numbers when you're getting in here into trillions of dollars, this is financial assets, whether they're actually held as physical assets or whether they're literally financial assets These are investments of various types. And again, this is done well for that sector of the economy. But if we look for drivers for the economy, this stuff essentially has been driven by a tremendous amount of liquidity in the market, very low interest rates. Can it keep going? Well, I don't, we're a regulator, we don't do financial forecasts, but probably as skeptical as anyone that that line for the Standard & Poor's 500 that's been going pretty much straight up since March of 2009 with the occasional hiccup, it can keep doing that forever. And that's one of the few lines that's growing, as fast, if not faster, as it did before the recession. So we've got so if you think about what's going to drive the economy, we've had some support coming out of assets, be it financial assets, be it real estate assets, haven't been doing so well out of consumer income and consumer spending, so there's not really a lot to look to. We're going to be able to kick the economy out of. And now we're going to get really into the investor behavior itself. So I've got two graphs here to focus on. The top one is mutual fund flows. Gray bar is for bonds. Purple bar is for equity mutual funds. So let's just spend a minute on this, because this, again, ties back into people's attitudes, but it's also what people actually do. It's when I make a decision in my 401k, when I make a decision as a corporate treasurer, but there's also a fair amount of retail that dominates this. These decisions are all fundamentally driven by individuals at one point or another. So we have, pre-financial crisis, this money moving in and out of equities, but until the Lehman Brothers collapse, it's kind of a mixed picture. Gray bars above the line are money going into bonds, and that's really the way early 2008 was. And then the financial crisis hits and money comes out of everything. And if we had a money in the matrix index, it would be exploding, but we really don't have something like that. And then we get to the end of the financial crisis, the first phase. So March 2009, the Dow's going to bottom at about 6,500. And money starts going back into mutual funds. Money is also going back into bond funds, and much more aggressively going back into bond funds. Equity funds do okay, kind of march sideways for a bit, and then the flash crash hits. Remember that? May 2010. Money comes out of equities, equity market recovers a little bit, money begins coming in, European sovereign debt crisis phase 1. And you get about 2 years of these purple lines below the 0 point money coming out of equity funds into bond funds. It stays that way until right at the beginning of 2013. And that's that big spike with a lot of money going into bond funds and a lot of money going into equity funds. We stay that way for equity funds for the balance of 13 and into this year. Bond funds switch in May, but before I spend just a second on that, what's going on in January of last year? You may remember there were articles in the press about the beginning of the Great Rotation. The economy was finally recovering, money was coming back into equities, it was time to go long stocks, all that kind of good stuff. I probably should have gone long stocks in March of 2009, but that aside, what I think that was, one of the reasons I think it's money both going into bonds and equities, and it was a record for equities, it was simply income being accelerated. I was talking about at the beginning. You had a lot of people getting bonuses early, dividend payouts early. You think about, so they wouldn't have to pay the 2013 tax rates should we go off the cliff as we did. You think about the type of people that have discretionary incomes that pay bonuses, and you think about the type of people that collect dividends. Both those tend to be households that are net savers, and if you also think about the timing, you don't really have that much opportunity to spend this additional shot of money you're getting right away. So what are you going to do with it? Let's put it in mutual funds. I think that's really what happens. So this is, as I was talking about at the beginning, tangible evidence of this income shock that the fiscal cliff gave the economy that wasn't in some of the more pessimistic forecasts for 2013, but it's a one-time. There was no acceleration of income in December of 13 because of changes in tax policy coming in 14. So this isn't going to repeat itself. And then this touching on the the start of the big outflows from bond funds. That's May. That's the first talk from then Chairman Bernanke about the taper. And this is where people begin thinking about the inconsistency between a lot of sort of the common wisdom or the media wisdom through the early part of the 2010s, which was bonds were low risk. You know, bonds, current yields are not low risk. They have just been low volatility through much of 2010, 11, 12. That is not the same thing by any means. And if you think bond yields are going to change, with bond yields as low as they are, bonds are not a low-risk investment, and so money began and continues to move out of bonds. You know, you essentially are making a bet on how taper ends, but it's going, or how taper and this whole monetary experiment ends, but it's going to end at some point. The bottom one is, and we're getting near the end, so I want to thank you for your patience. The bottom one is another one of these what do I do versus what do I say sorts of things, and it's like the top one. Blue line is, dotted blue line is the Dow. So there it's popping up to its record in November of 07, and then another one beginning of this year. And the red line is this thing called the State Street Investor Confidence Index. And if you're not familiar with it, it's kind of an interesting little animal. State Street is a big custodial bank. So lots of mutual funds, lots of brokers hold their money through State Street. And what they do is they look at the types of securities people are buying. If you're buying T-bills, selling equities, selling emerging growth stocks, selling risky things, and buying low-risk things, that's a low level of confidence. If you're buying growth stocks, if you're buying emerging market equities, that's a higher level of confidence. And you have two things going on here. You have the financial crisis, 2009, as low a level of investor confidence as this index has during the course of the graph I've got up here. And I think we go back to the beginning when they started producing this. And then you got it again right at the end of 13 as we're getting ready to go merrily off the, sorry, at the end of 12 as we're getting ready to go merrily off the edge of the fiscal cliff. So that's interesting enough, and it's come back, and investors are becoming more aggressive in their purchase and less defensive in what they choose to sell. But the other thing here, and this kind of goes into one of the things we worry about because we're a stock market and we're a stock market associated with growth companies and IPOs and things like that. There is this big long-term trend and increasingly less aggressive and more defensive types of investing across the 2000s. This is post-tech bubble. We're starting in 2001. The tech bubble burst in March of 2000. So it's not necessarily just the tech bubble, though that's probably part of it. And yeah, okay, there's demographics. None of us are getting any younger. And the population as a group is getting older, so becoming more defensive. But not getting older necessarily all that fast. So again, there's a dimension of demographics in here. But there may also be a dimension of, frankly, the stock market hasn't been very good for me for 10 years. And other types of investing haven't been very good for me for 10 years, whether it's real estate or what have you. Gold would have been good, I suppose, but State Street doesn't track gold. And so you have this sort of increasing preference on the part of investors as measured by this index for things that are lower risk types of investment, which is not really what we're all about. So we look at this one, and it's one of the things that we kind of worry about in terms of big secular trends for the business that we're in. But then we look at this and we get all happy again, and we stop worrying about the long term and go back to living quarter by quarter like any public company, because this is IPOs. And I couldn't be here talking about as part of NASDAQ if I didn't talk about IPOs, and this really is, I think, the last one that has any content to it. The number of cash raised, the amount of cash raised is in red, the IPOs are in blue. You can see the same types of patterns we've seen in other charts. You get the financial crisis. We had 2 quarters with no IPOs. I mean, we have data going back to 1971, and we had never seen that before. It was interesting to write the the 10K or the 10Q each of those quarters and the 10K at the end of the year going, yeah, it was a pretty lousy year for IPOs. We have never seen IPO levels this low. And then, you have dip again 2011, you have the sovereign debt crisis in 11, you have a flash crash aftermath in 10, you have another sovereign debt crisis in 12, all these causing the level of IPOs to dip. Now, one of the things that has been true about IPOs for a long time, well off this graph, is they kind of slow down for something like 3 to 4 quarters after a financial market hiccup or bigger than a hiccup. And that's essentially what we've seen this time. So the financial market's been pretty good for a while, obviously record prices on the stock market indices. And the IPO market's been very strong so far in 14, and knock wood, barring any kind of global geopolitical or macroeconomic wheeze, we should be in pretty good shape for the IPO market in the balance of the year. And I think there's been 30-some on NASDAQ so far this year, which is way ahead of last year. Like I said, that's it for new content, or for graphs. So just to recap, 2013, great year for the stock market, one of the best years we've had since people started tracking indices way back when. You don't do that every year. But there was an increasing appetite for risk. We're talking about equity fund flows, so that's State Street indices, the exchange traded fund for the home builders, all these kinds of things look pretty good. We haven't talked too much about Europe, but we have, and commodities, exchange traded funds and exchange traded products, they were weaker, which again, if you think about what a gold investment really is, it's something that has a negative real holding cost because it doesn't produce income and you have to essentially pay to store the stuff. And people were moving away from these types of things regardless of what they may think about inflation. It's just not been a great investment. In 13, the big, I think, overhang on 2014 is what's going to happen with taper and what's going to happen to those bond outflows, and is the taper going to create another major hiccup in the equity market as some of the other policy changes we saw over the last few years did? I actually don't think so. Again, Fed Chair Yellen is new. We don't, at least I don't. Some of you all may, but I don't know how to read between the tea leaves in terms of what she says. But taking what she's saying at face value, it seems as if there is not going to be an aggressive continued taper. There's going to be a slow winding down of Fed purchases of mortgage debt and federal government debt. But if anything, and of course the history of election years, both presidential and congressional, is the Fed doesn't usually go out of its way to disrupt the economy too much. So I think it's what we see right now from the Fed is pretty much what we're going to have for most of the balance of the year. That is halfway decent for equities, and it's halfway decent for other types of risky assets, such as real estate. The overhang is, when does this all end? When does the Fed essentially change the rules of the game, and what's that look like? So if taper remains a relatively neutral phenomenon, and remember this whole monetary experiment we're in is something that we haven't done. We don't really know how this book's going to end. If taper remains stability, essentially a non-destabilizing effect, and I do mean to use two negatives there. Decent economic growth, nothing particularly exciting, but nothing particularly horrible either. And the outlook for the types of assets that have done well in the last few years isn't all that different than it's been, except the valuations are getting a little high. If taper doesn't work, either there's not enough of it, it's too much. Financial markets have their own ways of dealing with things, and sometimes they can move quite quickly. Then we get bond market volatility. Bond market volatility will spill over in equity market volatility, and we get another bout of outflows like we saw in 2011 and 2010 as people decide, actually, no, it's not safe to go back into the water. And that, just go back to commodities briefly, changes the outlook for those too, because he now starts thinking of gold as a safe haven and other things as a safe haven again. And that's that. You haven't interrupted me, which is very nice. Somewhat unexpected, but that's okay. So I'll now give you the chance to, since I'm done, to either ask questions you've been holding very patiently for the last hour, or whatever subset of the hour I may have said something that attracted your interest, or we can see what's left from the beer and the wine bottles, because I believe there is a reception following this. Yeah, please.
Interest rates, how do you see that?
Yeah, so I take the stability, stable taper is the most likely outcome, which is stability for interest rates implicit in that, but trending up. I think we end the year with higher interest rates than we began it, not dramatically higher. You know,
On the long end, or?
yeah, on the long end, and there's different parts of the short end depending on kind of on what you're doing. So Fed funds stays essentially where it is. Some of the parts of the sort of near short ends, like NASDAQ, is an acquisitive company, and we tend to borrow at about 5 to 7 year horizons. Those costs may be higher. That's not really the short end, but it's shorter than 20 or 30 years. But I think those are going to both trend up. The Fed got a look over the summer. What happens if you spook the credit markets? I don't think they want to do that again. But at the same time, they recognize they have to get out of this monetary experiment somehow, because every historical precedent for essentially monetizing deficits doesn't have a happy ending. So they're, and the longer they go continuing to monetize, the harder it's going to be to eventually get out. So they've got to figure a way to do that.
So you think that 3 to 7 years at the end of the year is going to be higher?
Yeah. And I think if I were to be refinancing a mortgage at the end of the year, it's going to cost me more than it would if I were to do it right now. Now, I did it a few years ago, so I'm not doing it again right now. But that's okay. Yeah, Jeff.
Whether or not they can get out of this, what they've been doing, is one thing. But the longer term, looking at the Fed as a policy
Mm-hmm.
entity, do you think is there a sort of a frame of mind that they don't want to get themselves into this again, of taking on this central role of?
Yeah, there have been points in the past where fiscal policy has been enough out of joint that the Fed's kind of had to throw a lever in the opposite direction. This time, it was both of them full speed ahead as much as they can. Expansionary fiscal policy with big deficits, expansionary monetary policy with easy money. But the conundrum the Fed got into this time is that fiscal policy was highly uncertain, and that you can include sovereign failures in that uncertainty, at least on an international scale, depending on how you felt about the U.S. debt downgrade. So one of the things the Fed tried to do, which was sort of different than in the past, is whether in the past they might have leaned into the wind a little bit as the economy was recovering. This time around, they're like, look, there's so much uncertainty over on the fiscal side. We feel the need to make it clear to businesses that at least on a monetary policy, to this question about interest rates, there needs to be a little more certainty about what you can expect. So as for all of us who are running businesses, we're thinking about investment decisions, expansion decisions. You think of the things you put into a cash flow model. What's going to be the cost of capital, so interest rates and the adjustment for interest rates for risk, taxes, all this other stuff. Part of that equation, it was and continues to be somewhat uncertain. More so before the fiscal cliff than right now. So you leave the monetary piece relatively certain, more so than would have been the case, say, in a Greenspan Fed. And that was a very different situation for the Fed to find itself in. I think they want to extricate themselves from that. They want to be able to execute monetary policy with essentially an eye toward relatively low inflation rates, stable foreign exchange rates, things like that, not creating the kind of outflows that the emerging market economies have seen this year, and essentially not having monetary policy playing a central part to trying to get economic growth as going as it's now. And I think this probably also, again, depending on exactly what people's doctrinaire views are within the Fed, a realization of monetary policy can really only go so far, as plenty of Fed governors have said, it is pushing on a string. And there's a limit to what that really does for you. It's one thing if you're in a liquidity crisis and you're the lender of last resort. It's another thing if you're trying to get economic growth going, and all you can do is really offer cheap money. And again, you think about who can borrow money. It's for the most part entities that don't need it. NASDAQ has pretty strong basic cash flows in our core businesses. We're able to borrow money. If you don't have good cash flows and you don't have good credit, it's not been an easy environment to borrow money in. Yeah, Jim?
Yeah, Frank, do you see that the increase in oil reserves and natural gas related to fracking has had an impact on the recovery and what's going to happen going forward in the U.S. economy?
Has it had an impact? Yes. Is it going to have enough of an impact to close these gaps? No, not at present. I mean, we still import a great deal of oil. There's a prospect that we will become an energy exporter. We certainly are much less of an importer than we would have otherwise been. But I think for an industry to be transformational for the economy, it has to do more than essentially lower the cost of an input unless the cost of that input it's lowering is really dramatic. So we're talking about oil prices being cheaper and a balance of payments deficit being smaller than would otherwise be. But I think if you're going to be transformational for energy, you're going to be talking factors cheaper, a factor of 2, a factor of 3, a factor of 4. That has an impact on the economy as a whole, big enough to close these gaps. So in other words, I guess it's a nice to have, but in terms of shutting this gap in terms of consumer income and consumer spending, it's not sufficient to do it in and of itself. You think about things that have been transformational, the whole IT revolution, and really the massive upgrading of IT that was in the characteristic of the late 90s. You need something like that really is a major shot in the arm for productivity. And it's hard to see that just cheaper energy from fracking is enough to do that. Yeah.
The debate about the national debt seems to just go on
Mm-hmm.
without much happening. In your opinion, is it a problem?
Yes.
Comment on that?
Yeah. I mean, you think about what the sequester and the fiscal cliff were, and you've heard this line before, Randall, so I apologize, but it's pay more and get less. No one's going to run as a politician on pay more and get less. And that's essentially what we need to do to address this big fiscal gap. It's pay more, who pays more, and how, and get less of what. But the fundamental debate has to be along those lines. And whether you're when you look at the budget proposals that make at least if they were enacted as they're written, would make some progress in closing the deficit, what do? Where do you get money? Well, you get money from cutting the mortgage deduction further, and let's not delude ourselves that the mortgage deduction is already capped in terms of the total amount of mortgage you have, and there are phase-outs depending on your income, so the mortgage deduction is already limited, but you have to, if you're looking for money, that's one place to look. You can raise the tax rates. That's another place to look. You can significantly change retiree benefits. There's not that many places in the budget to find large amounts of money. And at the beginning of the financial crisis, the Washington Post, whatever view you all may have of the Washington Post out here, had a very good article that said, here's the budget, here's the pieces of it, here's the expenditure gap, and this is why this is going to be so hard to deal with. And that was back in 2009, over the next 5 years, and nothing in that article has changed. I mean, yeah, we took some chunks out of it in 2013 with the fiscal cliff and the sequester, but there's still, and again, if you look at any kind of forecast for the deficit, and I think I was gloomy enough tonight without putting one of those up on the screen, it just slows down for a little bit and takes off again, because the structural issues remain and largely driven by demographics. So to deal with that probably will require something like the late 70s, the Carter administration, Fed Chairman Volcker, and essentially a pretty nasty crisis, which is what we had at that time. When's that going to happen? I don't know. And this gets into the political mindset, hopefully after I retire. And so hopefully after the next election, hopefully in a way where we can blame each other and we all get reelected again. And that's, yes, very cynical, but nobody wins. Congressman Camp isn't going to win any particular credit for his proposal, and people who run against him will point at things that they feel the electorate in his district won't like and say, see, this is what he's trying to do to you. Which is one of the reasons the bipartisan commission made some sense, but it couldn't come to an agreement on exactly who pays more and who gets less and how. And it's just a really hard thing to do politically. So you let somebody else impose the discipline. And in the 70s, it was a market. For those of you who remember those eras, that era, inflation was very, very high, and there was active talk that the U.S. should issue debt denominated in Japanese yen and Deutschmarks, because repayment in dollars, which were inflating so fast, was too uncertain for the international debt markets. Yeah.
Just ask about the reserve currency, how critical is
Oh, I think it's a really big deal. I think we get a tremendous amount of benefits from being a reserve currency. And that's, when I talk about things that can be bad, that's the type of really structural change that promotes some kind of crisis. And secondly, it's something you then have to change and address. Fortunately for the U.S. in this last cycle, the euro turned out to have as many holes in it, if not more, as the dollar. That's, I think, exacerbated some of the economic tensions within Europe, because it's oddly enough made the Germans even more competitive in the international market, or the other Northern Europeans, because the euro hasn't been particularly strong internationally. But there weren't too many other places you could go. I spent a lot of time in Stockholm. The Swedish krona is pretty strong. The Swiss currency has been quite strong, and the Swiss government's taken action to try and reduce that. But they're not big economies. Where do you move this amount of capital? You need something quite large. And obviously that puts the Chinese economy and convertibility there into the spotlight. And I think the Chinese government recognizes that. And there's benefits to being the international reserve currency. The transition can be pretty tough because you do kind of begin to lose control of monetary policy to a degree. And you get capital flows that you lose control of. So they'll have to sort that one out in due time. Okay. Well, thank you. Thank you for coming indoors on a beautiful day.
Thank you, Frank. Certainly appreciate you coming indoors, being out of the nice, beautiful Seattle sunshine this afternoon. As Frank mentioned, there are refreshments back in the back, and certainly I'd love to have you join us for a bit of conversation. Myself and Frank and the rest of the NIRI board members will be here. Also wanted to thank again Jim and the Foster School of Business for having us here today. It's been a great pleasure and hopefully a good conversation. One administrative note, on the 17th of April will be the next NIRI Seattle event. That will be on shareholder litigation. So certainly a topic of great interest to a lot of the public companies here in the Seattle area as they see more and more pressure from shareholders to litigate against them in certain instances. So thanks everyone for participating and having taken time out of the sunshine this afternoon, and look forward to continuing the conversation in the back. Thanks everyone.